Have you ever seen a stock chart that just absolutely falls off a cliff? And you think to yourself, is this company toast or is Wall Street missing something huge? Well, today we're putting on our detective hats because we're going to dig into the really fascinating, complex story of UiPath. Let's get right into it. So, at the very heart of this whole thing is a $30 billion question. I mean, it's a question that has the market completely split. And to really get why, you've got to see one of the most wild valuation swings I think I've ever seen. Look at this. Back at its IPO in 2021, UiPath was the talk of the town, valued at over $30 billion. Fast forward to today, and it's sitting around $7.7 billion. I mean, whichever way you slice it, that is just a staggering collapse in value. So this brings us to the big question, right? Is the market right? Is this company just circling the drain? Or is there a hidden story here? A turnaround that maybe the headlines just aren't seeing? Well, our investigation is going to start with our very first clue, and it's hiding on the balance sheet. Okay, so our first clue, it's a big one, and it's actually hiding in plain sight. We're talking about a massive financial safety net that completely changes how you should think about what this company is really worth. And honestly, this is where the story starts to get really, really interesting. To get this clue, we got to talk about something called enterprise value, or EV. So for just a second, forget the stock price. EV tells you what it would actually cost to buy the entire business, the tech, the customers, the whole shebang, once you account for all its cash and its debt. And when you do the math here, it is so revealing. You start with that market cap, right? The $7.7 billion. You add a little bit of debt, no big deal. But then, and this is the kicker, you get to subtract a whopping $1.6 billion in cash and securities. That means the real price tag to buy UiPath's actual business is way less than its stock price suggests. Think about that. UiPath is sitting on a $1.5 billion mountain of pure net cash. That's not just some safety net, That is a strategic war chest. It gives them this fortress-like balance sheet and just incredible flexibility to make moves in the future. So, okay, the company's cheaper than it looks and it's totally financially secure. But that still leaves the big question. Can it actually make money? I mean, for that answer, we got to turn to our second clue, and this one's hidden in the income statement. In the third quarter of its 2026 fiscal year, UiPath did something it had never, ever done before as a public company. It reported a GAAP profit. Now, this isn't some small detail. This is a fundamental seismic shift in the company's story. They're moving away from that growth at all costs mindset to sustainable, profitable growth. So how'd they do it? Well, a big piece of the puzzle was an accounting move. But think of it like this. For years, because they were losing money, the company had to legally set aside a big pot of cash for taxes it might have to pay if it ever got profitable. By releasing that pot of cash, management is basically shouting from the rooftops, "Hey world, we're so confident we're going to be profitable from now on that we don't even need this rainy day fund anymore." It's a huge vote of confidence. And that confidence, that profitability, it's all built on an unbelievably loyal customer base. A 97% gross retention rate. That is just off the charts good. It means that once a company starts using UiPath, they pretty much never, ever stop. The product is just that sticky. But wait, it actually gets even better. It's not just that customers stay. They actually spend more money over time. 113% net retention rate means your average customer is increasing their spending by 13% every single year. That is the classic land and expand strategy, just working perfectly. Okay, so the financials are getting solid, but let's be real. In a world completely obsessed with AI, is UiPath's technology on its way to becoming a dinosaur? Well, that brings us to our third clue, a massive strategic pivot that's happening as we speak. So the old world was something called robotic process automation, or RPA. Think rigid, kind of dumb bots that just mimic what a human does. Click here, type there. But the future, that's agentic automation. We're talking about smart AI agents that don't just follow a script. They understand context, they make decisions, and they can handle complex problems. It's a total game changer. And the heart of this entire new strategy is a product they call Maestro. And the name is perfect. Think of Maestro as the conductor of an orchestra. It's not just managing UiPath's own bots, it's orchestrating everything. AI agents from other companies, even human employees, to get these really complex jobs done. Now, you can't have a conversation about AI in the business world without talking about the 800-pound gorilla in the room, Microsoft. And this relationship is the single biggest risk and opportunity for UiPath. It makes them what you might call a frenemy. The best way to think about this is like the brain versus the hands. Microsoft Copilot is the brain. It's awesome for your personal tasks, simple requests, things inside the Microsoft world. But UiPath is the hands. It's the execution layer that reaches out and connects to all the messy, complicated, non-Microsoft systems that huge companies run on, things like SAP and Oracle. UiPath isn't trying to be the brain. It's trying to be the indispensable set of hands. And this strategy creates what you could call the spaghetti defense. Once UiPath's technology is all woven into a company's most important processes, like closing the books or managing the supply chain, it becomes incredibly difficult and risky to rip it out. I mean, imagine trying to pull one noodle out of a giant bowl of spaghetti. It's a mess. The switching costs are just enormous, and that's exactly why you see that 97% retention rate. So we've looked at all the evidence, right? We've got the fortress balance sheet, we've got the turn to profitability, we've got the smart pivot to AI, and we have this really durable competitive moat. So now let's pull it all together and see what the final verdict on its value really looks like. When you actually put UiPath side by side with its peers, the picture becomes crystal clear. Look at this. It's growing twice as fast as its closest competitor, Pegasystems, but it's trading at basically the same valuation. And unlike a lot of the AI hype stocks like C3.ai, UiPath is actually profitable on a GAAP basis and has all that net cash. So this all boils down to what the analysis calls an asymmetric bet. The potential upside? It comes from this new profitability and its killer strategic position in the future of AI. And the downside? Well, it's pretty well protected by that huge $1.5 billion cash pile, which puts a very real floor under the valuation. So, at the end of the day, this is the question we're left with. All the evidence points to a company that's making a really successful, really difficult transition. But the market is still skeptical. So will UiPath manage to become the essential, invisible plumbing that makes the entire AI-powered enterprise work? Or will it just be a relic of an older, simpler time? The next couple of years are going to tell the whole story.